Welcome back to Investing Talk Podcast. We have actually had a ton of comments from you guys lately saying, please generate an audio summary for the Investing Talk Podcast for Rocket Lab. So we're doing exactly that today.
Yeah, today we're looking at Rocket Lab. And the so what here is that this company has fundamentally shifted.
Right.
For the longest time, they were viewed as this scrappy startup, the little brother in the space industry. But looking at the data for full year 2025, that narrative is just dead.
Completely dead.
They have posted record revenue, and for the first time, the numbers suggest they aren't just launching rockets, they are really becoming a dominant industrial force in space systems.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out.
Definitely. And just to tease where we are going today, the massive growth in their backlog is wild. It's up 73%.
Which is a crazy number.
It really is. But the crucial question we have to answer for you today is, can they transition from burning cash to actually printing it before the big Neutron launch?
Yeah, it's that classic growth dilemma, right? You've got the promise of tomorrow fighting the very real expenses of today.
Exactly.
So let's unpack the fundamentals. What are we seeing under the hood?
Right off the bat, the revenue trajectory is just undeniable. They reported a record full year 2025 revenue of $602 million.
Wow.
Yeah, that is a 38% year-over-year increase. And crossing that 600 million mark, it's a huge psychological and financial hurdle for them.
It really moves them out of that early science project phase.
Exactly. They're an industrial prime now.
I do want to jump in and verify the guidance, though, because four-year numbers are great, but Q4 specifically was strong, too. Right?
Very strong. Q4 was $180 million.
Right, which beat the estimates. The street was looking for, what, 178.18 million?
Yep. And you look at the Q1 2026 outlook, they are predicting $185 to $200 million.
So that implies continued sequential growth of 10 to 20%?
Exactly. They aren't stalling out. They're accelerating. But what gets me really excited here is the margin story.
Let's hear it.
Gross margins expanded to record levels in Q4. We are talking 38% gap.
Which is already high for hardware.
Right, but check out the non-GAAP, 44%.
44% non-GAAP gross margins.
Yes, a massive 44%. That is basically software territory for a company that builds literal rockets.
That is wild. How are they doing that?
Operational efficiencies from scaling up. The more you launch, the better you get at it. Plus, the integration of their acquisitions, specifically GEAST.
Okay, so owning more of the supply chain.
Exactly. Keeping more of the profit per satellite.
But the competitive moat really comes down to reliability, doesn't it? If the rockets blow up, the margins go to zero.
They do. But they had a 100% success rate on 21 Electron launches in 2025.
Flawless.
Completely flawless, and that reliability is what builds the moat we talked about. Their backlog stands at $1.85 billion.
Almost $2 billion in secured work.
Up 73% year over year, and a huge chunk of that is the Space Development Agency, or SDA, Tranche 3 contract.
Which is an $816 million award.
Right. And this completely differentiates them from competitors because defense work like this involves extremely high switching costs.
Break that down for the listener.
Once the government integrates your tech into their defense network, they are not going to swap you out for a cheaper startup next year. It's too risky.
So it's incredibly sticky revenue.
Exactly.
Okay, let's do a balance sheet check. Because all this growth isn't free.
No, it is not.
Total liquidity is near $1.1 billion.
Yeah.
And cash and equivalents are sitting at $833.5 million.
That is a massive war chest.
And they reduced their long-term convertible debt to $152 million. So they aren't drowning in interest either.
They are very well capitalized for the work ahead.
Okay, let's pivot to the price action. Because the books look great, but the charts are telling a slightly different story leading up to today.
Yeah, it's been volatile.
Today's Friday, February 27th, 2026. And between February 20th and the 24th, we saw a pretty noticeable slide. The stock was just edging lower.
I saw that. But you have to view that in context. It was consolidation ahead of the Q4 results.
So just pre-earnings jitters.
Exactly. People taking risk off the table before a big print. It wasn't a technical breakdown.
But then we had a post-earnings slide, despite the strong revenue beat. It looks like there's some heavy overhead resistance near the recent highs.
Yeah, but I call that guidance digestion.
Digestion. Okay.
Yeah. Look, it's been a volatile stretch for space stocks across the board. The pullback is more about capital rotation in the broader market right now, rather than a reaction to any fundamental weakness in Rocket Lab.
So you don't think it's broken?
Not at all. I actually think the stock is positioning for a momentum rebound once the market fully processes that $1.85 billion backlog.
It takes time for the street to actually price in that kind of contractual safety.
It does. And speaking of the street, let's move to market psychology and sentiment.
This is fascinating to me because I've been reading the headlines all week, and the tone is surprisingly neutral.
Very neutral.
You see headlines like Rocket Lab stock edges lower or earnings wait. You'd think with a 38% growth rate there'd be more fireworks.
I think the neutral mood was just that pre-earnings anxiety we talked about. Now that the official $602 million revenue figure is out, the sentiment is going to start shifting.
To focus on the backlog reality.
Exactly. The backlog changes the whole risk profile.
But let's look at the institutional flow, because big money has been making moves. We saw recent financing via $280.6 million in ATM sales plus preferred shares.
Right.
To a skeptic, selling stock looks like dilution. It looks like they needed a lifeline.
I completely disagree with that take. It isn't desperation. It is building a war chest.
Fixing the roof while the sun is shining.
Yes. They ballooned their equity to $1.72 billion. They are supporting their massive growth initiatives without any immediate liquidity fears hanging over their heads.
And they are focusing heavily on commercial wins, too, like those BlackSky multi-launch deals.
Right. It's not just government contracts. The commercial side is strong.
Okay, but I am the skeptic here. So let's look at the risks.
Go for it.
The profitability concerns are real. They had an EPS miss,
They did.
a loss of 9 cents per share versus the consensus of a 5-cent loss. And the metrics are rough. ROE is at negative 27.26%.
Yeah.
Net margin is negative 35.4%. Free cash flow remains deeply negative because of all this heavy spending.
I hear you. The burn is real, but there is a clear justification for that burn. It is completely deliberate.
How so?
It is funding the Neutron development and those SDA investments.
They have to spend the money to build a larger rocket.
Exactly. With $1.1 billion in liquidity, the execution risk is heavily buffered. That loss you see on the sheet is actually an investment in the Q4 2026 Neutron launch.
Okay, but what about sector volatility? If the market suddenly turns against unprofitable growth stocks, Rocket Lab could suffer some severe multiple compression, regardless of how big that backlog is.
That is a fair point. If there is a massive macro sector rotation away from high-growth tech, they will feel it. But the business itself is insulated by the cash and the contracts.
Which brings us to the bottom line.
Yes. Let's move to the final assessment.
All right, what is the verdict?
I am giving this a bullish score of 8 out of 10.
An 8 out of 10. That's a strong conviction play.
It is. Here is the pitch for you listening right now. 38% revenue growth, a massive $1.85 billion backlog, and the SDA win.
They are essentially positioning themselves as the only real rival to SpaceX in small launch and defense.
Exactly. And the catalyst here is that Q1 guidance signaling acceleration plus those 44% non-GAAP margins proving the business model actually works.
But the timeline requires patience.
Yes. This is a multi-year hold into the Neutron Q4 2026 launch. You have to be willing to ride out the development phase.
Well, there you have it. A record year, huge growth. But you have to have the stomach for the cash burn as they build the next big rocket.
Yeah.
If you found this analysis helpful, make sure to subscribe and leave a comment below. We want to know if you think Neutron launches on time.
Definitely let us know in the comments.
Thanks for joining us, and we will see you in the next one.